Greetings. Today we're going to discuss a topic of substantial importance to the entire global macroeconomy, and a question that is a source of confusion to a lot of people who study emerging markets or are trying to find an excessive number of comparisons between one emerging market and another when no such validity to these comparisons exist. And that is the comparison between China and India in terms of economic performance. Now, these are the two most heavily populated countries in the world, and India is soon going to overtake China as the #1 most populated country in the world. And these two countries, despite similar population with each other, are 4 times as high in population as the #3 country, that being the United States. So you have two countries that each have 4 times as many people as any other country. And for this reason, and also because they're neighbors, they are compared with each other, but the comparisons should actually stop there. This is a chart from Google of the per capita GDP of China versus India, 1960 through to 2018. I don't know why the data has not been updated after 2018 in the Google chart, but this is what we're going to use here. In 1960, per capita GDP US dollars, both of these were among the poorest countries in the world. China and India were both poorer than the average for sub-Saharan Africa, believe it or not. And they remained poor throughout the 1960s, 1970s, and even 1980s. China underwent a dramatic set of reforms and effectively redirected the economic structure of their entire country in 1978 and proceeded to grow very quickly from that point. India did a similar thing in 1991, but those were much more superficial reforms of no real significance, and the growth rate immediately before and after 1991 for India was not very different. But as you can see, the two countries were pretty much equal to each other until the early 1990s, 1992, 1993, and then China just shot ahead. Note that the vertical axis of this chart is logarithmic, so the gaps are much larger than they might appear in a logarithmic chart. They were equal until the early 1990s and then shot ahead. And now China is about 5 times as high as India in per capita GDP and is responsible for the vast majority of the entire world's poverty reduction over the period from 1992 to the present. Another way to look at this is through the suboptimal metric of GDP per capita in purchase power parity. So we go there. That calculation only begins from 1990, so this chart is over a shorter time scale. You can see how they were equal. They were quite literally equal until 1993. China only went ahead of India in 1993 and is now very, very far ahead, as you can see. India has no chance of catching up because nothing about India's trajectory indicates that it is about to kick it into a higher gear by any means. India's growth rate is not slow, but it is certainly nowhere near as fast as China. And even if China's growth rate slows, it is slowing at a much higher base, and therefore the gap between the two really cannot narrow very much at all. Now, what are some of the reasons for this? As we go back to the nominal GDP metric, the problem is India underinvests in its own people. It has underinvested in primary education, which China did not. In India, 25 to 30% of children are still illiterate, whereas in China, almost no school-age children are not in school. Secondly, India invests very little in public health. India invests only 1% of its GDP in public health, whereas East Asian countries invested 3 to 4 times as much as that in public health when they were at a similar stage of development. This causes a lot of economic costs in terms of epidemics, malnutrition, lack of vaccinations, things like that. So India has failed to do 2 very basic things that another 100 countries did before India to elevate their economies, and India somehow fails to do that still. Now, another factor in this divergence is the factor of very different currency strength between the two countries, and for that we go to another chart. This is a currency conversion chart between the Indian rupee and the Chinese yuan going back over 10 years. It does not go further back than 10 years. That would be even better, but the maximum distance here is 10 years. And you can see that 10 years ago, it was only 7 rupees to buy 1 Chinese yuan, and now it is about 11.6. So that is a substantial weakening, maybe a 65% weakening of the Indian currency in relation to the Chinese one. Most of this weakening happened in the first 3 years of this 10-year window, and it's been relatively stable for the last 7 years. However, nonetheless, this 10-year window shows a weakening, and that is also why India's economy is not able to grow at the same rate as China's in US dollar terms, because India's currency continues to weaken substantially. And there is a structural annual weakening that is built into the different trade balance profiles of the two countries. This means that India's growth is of a weaker quality than China's, and India's trade balance is also not nearly as favorable as China's, as we're about to look at next. This chart, which will also be in the description box below, lists the trade balance by country of all major countries of the world. And the good thing about this chart is you can just take your cursor above any country to see its balance of trade. Now, China has a trade balance of 3.63% of its GDP. That means its exports exceed its imports by an amount that is 3.63% of its GDP. So that positive number helps increase their GDP in addition to what the domestic economic growth is. Now, India has a number as well. Oh, it's almost the same number, 3.62. But wait a minute. You see that minus sign? That means India's trade deficit is minus 3.62%. So that is constricting India's GDP. India imports more than it exports by an amount that is equal to 3.62% of its economy in the most recent year. That subtracts from India's economic growth. That makes its currency weaker. And that means India's economic growth is of a lower quality than China's, and therefore the internals underneath the surface are much weaker. So you have plus 3.63% balance of trade versus minus 3.62% balance of trade. And this discrepancy encompasses the entirety of why the growth trajectories of these two countries are so different. China exports more than it imports, and India imports much more than it exports. Both countries are major oil importers, and the decline in oil price due to U.S. fracking benefited both countries tremendously, but China was able to do more with that one-time big benefit and redirect all that money into its own economy, whereas India was only able to get about 2 years of above-trend growth out of that before reverting back to a lower growth rate. So India is unable to take as much advantage of even these infrequent technological windfalls that befall the global economy, because India only gets a small amount of gain out of each of those. So this trade balance is very, very important as a reason for why a country might have more robust growth versus weaker growth. Incidentally, the United States has a trade deficit of minus 4.66%, so even worse than India. However, a prosperous country can withstand this type of trade imbalance much, much more effectively than a poor country like India can. So there you have it. Despite all the aspirations and the emotional need for a lot of Indians to believe that they can catch up with China, there's really no chance of that. The chance for that was in the 1980s or perhaps as late as 1992. But since India did not do the right things long enough ago, the gap is now too large for India to frankly ever catch up with China in an economic sense. Not everything China does is entirely ethical or even compliant with World Trade Organization regulations. We all know that for sure. And it's a good thing India didn't do all of those same things either. But at the end of the day, China has become an economic superpower. Its per capita GDP is about 5 times as much as India. And that gap is not going to narrow by much at all. There's no chance of that in the foreseeable future, despite whatever technological disruptions and other shifts in the global economy may occur in the next several years. That much is certain. If you found this type of video entertaining or informative, then I encourage you to subscribe to this channel, and thank you very much for watching.